We left off talking about investment analysis and noting that there's 4 different modes by which you can compare alternative investments. These are the payback period, the simple rate of return, net present value, and internal rate of return. We're going to talk about how you calculate all of these different methods of comparing alternative investments in the video today, and then in lecture on Monday we'll actually work through examples to illustrate these concepts. Payback period is probably the most simplest of the 4. And payback period is simply the number of years it would take for an investment to return its original cost through the annual revenues that it generates. It's very easy to calculate. Payback, which is indicated in the equation here with a P, is simply equal to the initial amount of the investment, which is indicated with I, divided by the expected annual net revenue, which is indicated by E. So what this does is it gives you a measure in terms of the number of years over which you would expect the investment to be paid for by the cash flow generated from that investment. Again, this is probably one of the most straightforward means of calculating a way to compare alternative investments. But that doesn't mean it isn't without fault. In fact, it's got some advantages, but it also has some disadvantages. Now, one thing that's important with payback period is that what we often do is set a maximum payback period and then reject all investment alternatives where that payback period is greater than the maximum. So some firms might say they need to be able to get a payback period of 5 years for any kind of investment, and if it takes 6 years or more to get the payback from the investment that they've made, then they choose not to pursue that investment alternative. Now the advantages, as I indicated, are that it's very easy to use, it's easy to calculate, and it can also quickly identify investments with very immediate cash returns. So this gets at the notion of cash flow, and in fact this is a good measure of the cash flow and how the cash flow can be used to pay back an investment. Now disadvantages is that it occurs any cash flows occurring after the end of the payback period. So if the cash flows actually increase after the payback period, you wouldn't be able to capture that in this type of method of comparing alternative investments. As well, it doesn't account for the time value of money. And lastly, it's not really a proper measure of profitability. All it tells you is the number of years it's going to take for the investment to be paid off. Now, an alternative way to evaluate investments is to calculate what's called a simple rate of return. And a simple rate of return is expressed as the average annual net revenue as a percent of the investment. So all you have to be able to calculate is average annual net revenue and then divide investment by that, and you'll get some percent return. And so if we were going to do this mathematically, what we would have to know is what our average annual net revenue is. Now to do that, we would actually take our average net cash revenue and we would deduct the average depreciation. Depreciation is the cost allocation associated with a particular asset's use in a particular year. We'll talk about this a little bit more in the example in class. So we need some information that goes beyond what you would need for the payback period, but this does give you a better sense of how profitable this particular investment might be. Its advantages are that it considers an investment's earnings over its entire life. So unlike payback period, this would look at the rate of return that you would expect to receive from that asset over the course of its entire life. A disadvantage is that it fails to consider the size and the timing of annual earnings, which could have some cash flow implications. This just looks at an average effect. It doesn't look at whether or not you could actually have the cash flow available needed to pay off that investment over its initial period. The gold standard in much of this analysis is something that's known as net present value analysis, or NPV. This is used actually in many different circumstances. Net present value of an investment is simply the sum of the present value of each year's net cash flow less the initial cost of the investment. Now what's important here is that it's the sum of the present value for each future year's net cash flow. And so we have to be able to observe or have an estimate of what we expect to earn in future years because of this investment, and we then have to be able to discount that back to present value terms. This is the equation that we use to calculate net present value. It looks complicated, but it's actually quite straightforward to use. NPV is the net present value. P1, P2, and Pn are the net cash flows in any given year. So P1 is the net cash flow in year 1, P2 is the net cash flow in year 2, I is the discount rate, and C is the initial cost of the investment. And so in this particular example, if we want to think about taking this element that I'm circling with the mouse here, what we've got is the cash flow, the net cash flow in year 1 divided by 1 plus I raised to the power 1. Well, that's just a discount rate. What we've done is we've discounted that cash flow in year 1 back to the current term. That's the same thing that's happening in the second term in this summation, is that we've divided the net cash flow in year 2 by a discount factor for year 2 to state that the net cash flow in year 2 in terms of the present value. Now, you also need to be able to know the life of the investment. So we have to know for how many years we're actually going to be discounting. And lastly, you need to know the cost of the investment. We'll work through some examples using this equation in class and also in lab and assignments. Now, what's important with net present value analysis is that it actually gives you some very powerful information. You would only accept investments that have a positive net present value. If the net present value were less than 0, what that says is that after you account for the time value of money, the net cash flows are less than the initial cost investment, which suggests that this is a profitable investment to undertake. If NPV is greater than 0, that is, if the discounted cash flows exceed the cost of the investment, that also provides information. That tells us the actual rate of return for that investment is greater than the discount rate that's used in the calculation. That is, the return is greater than the opportunity cost of capital. It also tells you that you can afford to pay more for the investment than perhaps you already are investing. The advantages of net present value is that it accounts for the time value of money. It's considered one of the best approaches by many experts. It does not result in misleading answers in that it doesn't avoid or ignore future cash flows or take an average over future cash flows. It's relatively easy to use, and you can adjust the discount rate to allow for inflation and growth over time. There aren't many disadvantages to using net present value other than you sometimes have to do a lot of calculations, but many spreadsheets actually have functions pre-programmed into them that would allow you to do this in a relatively straightforward manner. The last way that we think about comparing alternative investments is to calculate what's called the internal rate of return, or IRR. This is perhaps the most difficult of all the 4 methods that we've been looking at in terms of how you actually do it. The mechanics aren't entirely intuitive, and in fact the mechanics sometimes can be a bit of a chore to undertake. Internal rate of return is actually very simple. It's the discount rate that makes the net present value of the investment equal to 0. And so what we do is we take our net present value equation, we substitute in our annual net cash flows in each of the respective years, we substitute in the cost of the investment, and we set NPV equal to 0, and then we try to solve that net present value equation for I, the discount rate, or the rate of interest. Now, as you can imagine, the term with the i's are polynomials to different powers, and so this becomes a very complicated and in fact difficult calculation to do. But IRR can be found through a number of software programs, but without those you must go through a process of trial and error. Excel is an example of a software program that actually can allow you to calculate internal rate of return, and so in some ways the heavy lifting is done already for you. If you didn't have a software program that did this, you would have to go through a trial and error process. And with the trial and error process, what you do is you pick some assumed value of the discount rate and you calculate the net present value at that assumed value. If the net present value is greater than 0, then the IRR that is higher than the assumed value of the discount rate. If the net present value is less than 0, then the IRR, the internal rate of return, is lower than the assumed value of the discount rate. On the basis of whether or not the IRR is higher or lower than the discount rate that you've assumed, you would then adjust that discount rate either up or down and calculate the net present value again to see whether or not an NPV is greater than or less than 0. And then you would again adjust the assumed discount rate again on the basis of that calculation, and you would iterate that process until you came to the point where net present value was either exactly equal to 0 or very, 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 very close to 0. So that trial and error process can be a bit of an exercise and a bit of a chore. Now, that's worth the effort because many people use internal rate of return. And it's useful because any investment with an internal rate of return greater than the opportunity cost would be profitable. So as soon as you know the internal rate of return, and if you know your opportunity cost of capital, you know whether or not that investment alternative is profitable. Moreover, you can rank different investments on the basis of their internal rate of return and compare them on the basis of IRR. That's quite useful when you have investments that have different initial costs and different lengths of lives. So for instance, if you had one investment that was going to be over 5 years and another investment that was over 10 years, you might be able to use, or you would be able to use, the internal rate of return as a means of comparing those investments that span a different period of time. Now, there's a number of different factors that are important in considering investment analysis. We're going to talk about 3 of them that tend to be the most important. And these are 3 factors that can all be used to adjust the discount rate when you're undertaking this type of analysis. One factor is income taxes. There's one thing you can't avoid, it's income taxes. And income taxes will reduce the net cash revenues with the amount depending on the marginal tax rate that is being applied. And so investments should always be analyzed using after-tax net cash revenues. Taking the tax out will actually give you a clearer picture of the net benefits that are going to be coming towards you, as opposed to gross benefits that will be coming towards you from which you would then have to pay taxes. Another factor that's important in investment analysis is inflation. This is just the general price of goods and services in the economy, the overall level of prices in the economy, if you will. And a general increase in prices will affect net cash revenues, also the terminal value, and the discount rate. And so sometimes if inflation is an important issue, people will adjust the discount rate so it's what we call a real discount rate plus an inflation rate. What that does is that makes the discount rate a little bit higher, and it actually reduces your purchasing power further into the future. And so it makes the decision a little more conservative in that regard. Lastly, risk is very important in all of this. And estimated values that you're using to calculate net present value will depend on future prices, and those future prices could be highly variable. Think about trying to do a net present value for an agricultural commodity where you're trying to predict prices 5, 10, or even 15 years into the future. There's a lot of variance and variability and risk that those prices might exhibit that makes it difficult to actually estimate those values that far into the future. And so when that happens, we will sometimes adjust the discount rate to reflect risk. And we would take a real interest rate and we would add to it a risk premium. So if we had an interest rate of 5% and we thought risk was very important, we would try to estimate a risk premium and add that to the 5%. So for instance, maybe your risk premium is 6%. So now instead of using a 5% interest rate, you would have an 11% interest rate. And again, this serves the purpose of giving you a higher discount rate that reflects the premium that might be needed in order to bear the risks. And it also embodies the fact that some of those estimated values might depend on future prices that are very difficult to estimate and might reflect a high degree of variability. We'll end it there, and we'll pick up with some examples that show you how to calculate both the simple rate of return, the payback period, net present value, and internal rate of return in lecture on Monday.